All right. Good morning, everybody. Let's do the thing. Volume is really low this morning. 30,000 compared to yesterday at 40. See the US markets all at the bottom here, barely moving at all. Japan up 0.5%. The world's just waiting on data. Little bit of news. Haven't seen too much of it yet. But there was a railroad strike that shut down Canada United Kansas City, and then no, that ain't the name. Two railroad companies, and it's I don't know, it's just kind of kicking off. So see where that goes today. We're going to get some jobs data. Remember that this goes to the heart of what the Fed is working on, and it's a part of the big sell-off that we got. That whole big move, some of it was a volatility squeeze, some of it was the Japanese carry trade unwind, some of it was the job numbers. So anything jobs related, you want to pay particular attention to. Then we've got manufacturing PMI, existing home sales. We got the 30-year bond today. It's kind of a big deal. My baby. And like I've said before, if we have an auction at 11 or 11:30 or 1 o'clock, then you want to pay particular attention to the others. Even if it doesn't show that there's an 11 o'clock auction, if we have one anywhere else, assume that we have one at 11. So don't miss that. I know, I get it. You look at this, we go through 3 different pages, and you would think we've got all of the economic events scheduled. But this isn't even half of the events that are going on a day-to-day basis. We're not seeing all of them. You'll never find all of them. It might be Kansas City Southern, but I was pretty sure that the 2 railroad names that I heard both had the name Canada in it. One of them just also had Kansas City in it. So it was like Canadian Kansas City something or other. But there are a strike going on over worker safety or worker fatigue or something like that. They couldn't come to a balancing point, and so the doors were shut and locked, and they went on strike. That happened overnight. I've had a lot of people reach out asking, what do I think it's going to do? Where are we going to go from here, with this market? And you can try to play guessing games all you want, right? Everybody's got an opinion, just like everybody's got an armpit, and they probably stink as much as their opinions do. You can guess or assume or try to extrapolate what we're going to do next. I've found that that doesn't usually work very well. What does work is playing what I have, and consistently that works. So with this current bar, it's a weekly bar. The weekly bar isn't closed, so it doesn't count. We have the last weekly bar, which is closed, and so that one does count. It's not falling yet. We won't know if it's going to fall because we don't know what Jackson Hole's going to bring us. We don't know how the market's going to respond to the 30-year. There's so much that we don't know that has no bearing on this chart at all. No candles, no analysis that can be done because we're not analyzing Powell or Jackson Hole or the bonds. We're looking at one single chart. what's going to happen to dollar, yields, oil, gold. All of that is going to affect this chart. So you can ask as many people as you want. And if they're being honest with you, they're going to tell you, we have to wait and see how this pattern plays out. We have to wait on the data to come in. And there's no reason to try to guess or assume or position one way or the other. Now, everybody realizes that, Vegas makes a ton of money because people love to gamble. So if you want to risk it, step up and risk it. Me, I like my money. I want to wait for, something to play rather than something to speculate. Weekly volume profile. On the week, we are above the point of control. We left that behind yesterday after all that violence and shenanigans. We've talked about this 57 level before. It's still there. It's a cog line too at 56.92. If we get this breakout that continues to move to the upside, then we still have that to deal with. I had mentioned this area previously, 56.50. It's not a surprising number. It's an options level. So we knew there was going to be some trouble there, but we still have this one overhead, 56.92. When and if we get back into that, it's very likely going to be difficult to get through there in the first shot. To the downside, once we get through 5,600, we've still got a little bit of help around 55.65. Central pivot range with a floor pivot in there. Today's floor pivot higher than yesterday's. Price opened higher than that. It's completely outside of the range. They're not overlapping in any way. The channel's a little wider today than it was yesterday. A wide channel implies that breakouts won't stick. We're still waiting for the AM edition of Spot Gamma. We don't have it yet. So we want to see anything that talks about the call wall and the put wall. Are they getting moved? Because having them roll up or roll down is a nice tell for what markets are expecting. And for the distance from the weekly floor pivot, we're really no farther away from it now than we have been on Tuesday. So, from that point of view, we're not overbought, we're not overextended or stretched or anything like that. It doesn't owe us anything. On the average daily range, we're basically flat this morning. So we're no closer really to one side than the other. There's not a lot of edge on trying to guess if we're even going to go to one side or the other. We're still in a high volume environment, but the 21-day average daily range has now dropped below $100. And that's because we've gone sideways for 3 days now, for 2.5 days. And so the numbers have finally dropped to this lower value, finally. But that's still very high compared to the daily 1 standard deviation or the daily expected move, which is pricing in $50 and 45 and 55, and we're at 95. So price is still moving farther than it should. That is the very definition of volatility. There's a base case argument that will hold the line into Jackson Hole, and I'm not so sure about that. The more work that I've done looking at Jackson Hole over the last 4 years, most of the time we did not go sideways into Jackson Hole. We moved up into it or we moved down into it. And sure, this week we have been, other than Monday, we have relatively been doing sideways, but we've got a lot of data coming out, especially today, that the market's going to be paying particular attention to. And you saw how they responded yesterday when the BLM numbers were late. They were supposed to come out at 10 o'clock and they didn't. And then they come out with some BS numbers like 15 after, and the market started to respond to that and was like, wait, this isn't what we're looking for. Then they did come out with the numbers and the market ran it up and immediately changed its mind. That wasn't a rug pull yesterday, right? If you look at Monday or if you look at Tuesday, that was straight up a rug pull. That was a bull trap, and they yanked the rug right out from underneath them and dumped it on their head. All the options flow was going down as soon as the market opened yesterday. There was no algo flow to the upside. So this was a fake out, a deliberate play. That's not what happened yesterday, right? Yesterday, they ran it up. The algos ran it up. All the flows ran it up. And then they just straight up changed their mind and said, nope, screw this, and dumped it right back down. If the funds and the firms can't make a decision about what the heck is going on, don't feel bad if you can't. Canadian National and Canadian Pacific Kansas City. Thank you. Yes, that's the one that I heard. So it really hasn't started to grow legs yet, but a railroad on strike is a big deal. So looking to see what's going to come out of that, if anything, right? They may solve it really early. And I'm just surprised at this point, we're not really hearing more about it yet. So we are expecting to stay within the red lines today. If we expand some, we could get into the yellow lines today. It's still within our ADR, but Jackson Hole still looms. So even if we do get some violence or volatility today, we're still going to be expecting the market to take a breather and focus on the idea that we've got Jackson Hole tomorrow. Those job numbers are front and center, the most immediate threat. I laid this out before we started the stream. It's like one of those micro double tops. Like I've mentioned before, double tops and double bottoms are traps, but they're only a trap if we go in there. When you have price come up and make a double top, if it doesn't break above that previous pivot point, then it's not a double top. It's more of a cup. And cups have a handle, and then they follow through to the upside. Now, this could just crash right back down, right? Because this isn't a very pretty looking cup. So if we do get up here, then we'll have a double top. And that's where we could see the bulls get trapped because it's a sell zone and we fall out of that. We don't have to. It's a sell zone not telling us to sell. It's a sell zone reminding us that liquidity resides on the other side of the pivot, and that's where sellers are at. If we get through those sellers, then we go to the 50% mark. We have the same setup on the NASDAQ, by the way. You see the volume is still really light, but we don't have a hedging yet. This isn't my opinion. If there was hedging, we would see the market maker move up there. And that doesn't mean that they can't come in and start hedging. But if they were really concerned about those job numbers, they would be hedging already, right? The job numbers are going to come out at 8:30 and they're not hedging. One reason that they may not be hedging is because they're not positioned big enough to need a hedge. After the OPEX, with all of this looming event on the horizon, it wouldn't have been very much of a surprise if a lot of those firms didn't put on a new position and just waited it out. The point of control has moved to our location like we talked about earlier this week. We were expecting it to move from down here to up here. If we stayed here, if we left that range, then we weren't expecting it to move for another week. But if we stayed in this location, that was the most likely outcome. Well, we got it. It's there. Now what? Well, these points of control are a little bit like gravity or a magnet, but it's not a support and resistance level yet. We wouldn't consider it that way unless we expand far enough away and then we come back and we test it to see if it's going to act as support. Or we get far enough away and we come back and test it and see if it'll act as a resistance. But as long as we're just crisscrossing back and forth through that thing, then we can continue to do that back and forth, and it wouldn't be considered a support or resistance level, not even a potential support and resistance level. This is a really nasty profile, and it's not a classic shape of any kind. You know, generally we'd have the capital D or a capital P. We got nothing here, just levels of structure. And if we break below, say, 5,600, we get into structure. We break 62, we get into structure. We break 50. You see, we just work our way down level by level by level. Not counting all of this profile structure, there's major moving averages underneath this, right? Because we're above all of those again. So there's pivots, there's volume structure, there's moving averages. There's a lot of things under this market. But when it comes to economic events and data points, we can crush through all of that, right? All it takes is a macro event, news to come out, and none of those pivot points and moving averages and structure will matter. We'll run right through it. Where they do matter is just on your day-to-day grind. If we, break the low today and just start grinding to the downside, all those levels will matter. But if news comes out and sends us shooting to the downside, well, none of those levels will matter at that point. We are on the edge of the weekly expected move. This is how far the market was expected to move for the entire week. We reached it yesterday and pulled back from it. We're back to that level today and just slightly above it. Generally, we close inside the week's range with a 70%. That's what a one standard deviation comes up to. If we round a little bit, 70% of the time we close inside this box. That's if we were looking at any normal product, Apple, the Qs, just any general product, supposed to close inside the range 70%. The S&P's got a more accurate expected move than anything else. One of the reasons for that is it has more expirations, and for years it had more expirations in the options than any other product did. It's the experiment product. So while a lot of places only had Friday expirations, the ES used to have Monday, Wednesday, Friday. Now it's got Monday through Friday. And, you know, if you weren't around back then, doesn't matter. For years, this was the most liquid thing. These expected moves comes from the options chain, and that high volume of options data is why it has such an accurate expected move and why generally it closes inside the range 80% of the time. The thing is, when we're in a high volatility environment, and I'm not talking about looking at the VIX necessarily, just high volatility as in big, massive candles on a daily basis and a consistent escape outside of our daily range, big moves, then it calls into question the accuracy of the weekly expected move and the expectation that we'll close inside of it. If 80% of the time we close inside, we're in the market environment of the other 20%. We would expect to close outside of the box more often than not, like we did last week. That was our range last week. Price broke outside of it completely and went an additional standard deviation at least. We are more than 2.5% above the 10-week. It's in our sweet spot. It's not overbought. It's not overextended. It doesn't owe us a pullback. It hasn't moved it too far, too fast. Everything is right where we would want it to be on the weekly. We're good. On the daily, we're a little ahead of ourselves. The sweet spot's about 1.5% away from the 10-day moving average, and we were close to 2.5%. And we faded off from there, but we're still 1.75 above that 10-day moving average. That's a bit more than we want to see. So we still need a correction. Now, markets can correct by pulling back, or they can correct by just going sideways and giving that moving average time to catch up with us. This is Jackson Hole of last year. The event was on Friday, so the line is kind of in between these 2 days. It's a thinkorswim thing. 825 was the Jackson Hole day, but we broke outside of the weekly expected move that week on Wednesday. And then on Thursday, we came crashing right back down again. And then we had Jackson Hole on Friday, and we really didn't do all that much. So we got nat gas down, the VIX, gold, and bonds, and solar. It's not really all that exciting yet. The Mag 7 are down, at least the little homemade Mag 7 group that we have here. Needs to be updated, it looks like. I don't think, I know AMD is not in there anymore. AVGO is in there now. It's still down. Semiconductors are up 0.5% with tech. This Mag one is up, so it's very likely that there's a Mag 7 name that's dragging the combo down, and yet that is working. So we'll dig a little deeper into that. We got a lot of these single stock ETFs. I know it's weird, right? Because an ETF is supposed to be a basket of stocks. So how can you have a single stock ETF? Whatever. That's what they're called, by the way. You can go dig them up and take a look at them. I added a couple of these double, triple leveraged single stock ETFs, And the ones that are up this morning, NVIDIA and Tesla and coin. But once we get past those, we've got the China large caps. So FXI, that's up 0.5%. The China ADRs, the internet ETF for China KWeb, it's up a little, but not up enough. We need this up another 25% at least, 0.25%. Generic speaking, tech is up XLK, but not by much, right? We got the gap up and then it just stalled there. It's not really moving or doing anything at this point. SMH, so semiconductors getting a little love, barely got the inside day breakout, but it looks like it's stalled there, not getting anywhere. It's a market that's waiting. So here's the Mag 7. Not all of them. I don't think I have Broadcom on here, but most of them. And we're on a 24-hour chart. I do this because Thinkorswim's daily chart won't show intraday price candle. It won't show anything for today until 9:30 at the open. So if you just set it to 24 hours, it's really close to a daily. But it has the pre-market on there even before the open. The difference would be, here's a daily. Look at Amazon up here and Amazon here. It has the big bar on this day for an example, but the daily shows the gap up where we closed down here, ran up and gapped up here in the overnight, and then every one of these other days. There was no gap here on the intraday, the hourly. So a little tip, just use a 24-hour chart in the pre-market. You can see that today's candle on the 24-hour, we have a candle, but on the daily, we don't have anything here yet. So Netflix is down this morning, and that's it, right? Microsoft is flat, Amazon green, Apple green, Google, Meta, Tesla, NVIDIA, they're all green. They're all green except Netflix. I mean, they're not crazy wild bullish green. They're still stuck within their range. Every one of these is within the range. They're not breaking out into, I don't want to say blue skies, but they're not breaking out even above their previous candles. Apple's the closest one to a breakout right now. So we need the data. That's what it just comes down to. We need the data, and we have a lot of threats on the table today. And there's no reason to try to guess or assume that we know how the data is going to play out. We just have to get it. The dollar's back above 101. That's a good start. If things go sideways today and we see the dollar get below 101, then the idea is going to be we want to see the dollar stay in triple digits. So it needs to stay above $100 even. Getting below 101 is going to call that into question. We got the 10-year back above 3.8. That's a good start. But again, if things start to go sideways, one, let's see it get back inside of its own regular trading hours high. Get back inside of that. Then the half back of yesterday. Then we'll look for a breakdown below yesterday's low. Imagine the 10-year under 3.75. I think the market will throw a fit. We got the VIX above 15. Keep an eye on that today as well. We don't want to see it continue that move to the upside. $20 is the level we really want to see it stay under at this point. Just keep it below 20. So as you can see, there's nothing out there, right? We got pot stocks and solar, and you don't want to rally on pot stocks and solar. So we need that data to come out. And just be careful with it, right? There's more than one data set today. We're going to get 8:30 data, and then 10, and then 1. And we're still on the lookout for tomorrow with Jackson Hole. Everybody be careful, be safe, watch the clock. We'll see y'all tomorrow.